Hello traders, welcome back. My name is Neville, market analyst for YouTrading, and today I'll be taking a look at the week ahead. So first things to note is today, Japan and China are on holiday, and then that holiday extends into tomorrow for China. On Wednesday, the Hong Kong Stock Exchange will also be closed because of the same holiday period, festival, that China's respecting today. They respect on Wednesday too. So there is a risk event happening in China. Basically, their second largest housing builder is going to default on its debt. And it's just a shame that this bank holiday occurs today and tomorrow, because I'm sure there's going to be some sort of movement within the yuan and related currencies. And hopefully we'll talk about the risk itself, but hopefully there's no contagion sort of spread across banks. Okay, looking at today, we've got the Canadian federal election. So we're looking to see if Justin Trudeau gets re-elected and whether that has any sort of bearing on the Canadian dollar. Tomorrow, we learn from the RBA about their monetary policy meeting minutes. We get to see how they discussed holding off from tapering any more of their asset purchases and how they sort of see the economy going forward. Wednesday is the pivot for the markets. That's the focus. We all want to know what Fed Chair Powell is going to say in the press conference. We get the pre-written statement at 7 p.m. and their economic projections, but Fed Chair Powell will be quizzed on the transitory nature of inflation. He'll be asked about the risk events that are happening, both with the Evergrande company in China, but also with the debt ceiling and the problems that brings on for the US itself, and also how we're going to start tapering assets or going into a rate hike cycle. So all of that would be really pivotal for the US dollar and the equity markets. Thursday, Japan's on holiday again, but we learn from the SMB about their monetary policy assessment. And we also get the flash manufacturing PMI and services PMI from Germany. And obviously Germany is the manufacturing powerhouse of Europe, and the flash reading is the first indication of how well they're doing. It's expected to come down a little bit from the previous. So, might be an upturn in the euro if that figure should beat. We also learn on Thursday about the MPC asset purchase facility voting from the Bank of England and their monetary policy summary. And then on Friday, we get to hear from Fed Chair Powell again, but he's probably just going to reiterate whatever he says on Wednesday. So there is some central bank heavy sort of tier one data. There's also these bank holidays, which are entwined with risk events that are going on in and out of China. So looking at the active trader platform, you see here that the US dollar itself has gone up to previous resistance that we saw in the end of March, the swing high. We did sweep those highs back in August, so last month, and then we're just approaching that price level again, so getting close to the $93.50. Whether or not there's still sellers here is to be seen. Obviously, if there's flows into the safe havens, the US dollar is the global reserve currency, so that obviously catches a bid. Depending on how bad, as we're going to discuss, the sort of risk events are, whether or not there's more and more push into this US dollar. Back here, we had the FOMC, sort of the hawkish meeting in June, and if the Wednesday's meeting is perceived to be hawkish, then again we see the US dollar run into this overhead resistance. It's above the 3 moving averages. The 200 is here in Siam, back down at $92, and the 20 and the 50 are stacked on top, looking bullish and curling up. So the momentum is to the upside. We just need to see if we can get price action to confirm that, or whether or not we get some sort of crazy reversal. Right, going to the Evergrande, China's second largest real estate developer, is widely expected to miss interest payments this week and next week for 2 US dollar bonds that mature in 2022 and 2024 respectively. and this is signaling a possible subsequent default on the company's debt. Now, China, they're trying to regulate heavier. They're trying to get companies to deleverage, and this to them is just a cesspit of debt and speculation. They've built houses and buildings that people probably don't need. They've done it on margin, they've done it on debt, and now they're not doing very well. But they haven't been doing very well for some time. Obviously, they suffered like the rest of the world in March 2020. But they didn't. But then they had a bit of a rebound. The reflation trade. When China was growing, they were like putting money into these sort of construction projects, and they just haven't done it for companies like this year. And so when we broke support back in September, well, the September 20 support and then the March 20 support, back here in sort of May, April, there's obviously just no return. Analysts have been looking at this company for a while, like wondering how they're going to pay the debt, and now it's become apparent that they can't. So this is now probably a dead company, but it's probably going to default. The issuers of the debt are going to have to take a haircut. And from what I've read, most of the banks that own this debt, they're generally in a position where they've reduced their debt as much as possible. The actual company Evergrande are doing a fire sale of all of their properties, and obviously they're never going to be a premium price again, because whilst they're in the hands of Evergrande, people know that Evergrande need the money to pay this debt, so they're going to just force the property prices right down. The yield on the debt for 2022 is now up to like 500%. So this is a real sort of watershed moment for China. Will they let this, the second largest real estate developer, just die? Will they step in with some sort of help when they try and rejig their finances? Will the issuers of debt just take the haircut and take some property? It's all to be seen. But for the market, it's whether or not there's some sort of, if the people holding this debt can't pay, down the line, then that's contagion, and that's what the global sort of risk is at the moment. And if we go back to previous global risks, liquidity events are when money just sort of stops moving. The leading indicator that a lot of analysts will look at is the yield curve between the sort of spread between the 10-year and the 2-year for the US debt. And you can see that when it goes below zero or towards zero, it's normally a leading indicator for a coming recession. So back in 2000, the start of 2000, this spread got to zero. And then by 2002, we'd gone through the dot-com bubble sort of bursting. Then again, February 2006, it sort of indicated that all was not well with the stock market. And you can see that 2007 came along, and we all know that this was the great financial crisis, another liquidity event. And then here you have the last time it happened was August 2019. And then this little blip now on the orange line, which is the S&P futures. This was the COVID coronavirus sort of market crash, which ended up being a 2-month recession. But you can see that once again, the 10 and 2 spread basically signaled that something was not right in the system. And it just so happens that the coronavirus came along and made that worse. But, if this was the low, then, we're just maybe remapping these fractals from before. But, looking at what has happened, we've had a big run up and pullback, and it's normally on this pullback that we get, the final leg. So if this is a liquidity event at the start, then like an insolvency event is normally the one that follows, and that's normally the market reset. So that's why you have these sort of prolonged periods of downturn, that lasts a couple of years at least, or a year to 2 years. So we didn't get that. We only had like 2 months. So if this was the liquidity event where people just shut down and said, like, I don't know what's going on with this coronavirus, the worry is that there's going to be an insolvency event. And companies like Evergrande who are going insolvent, that's just a leading indicator that it could happen to anybody, especially if you've got like high debt. Talking of debt, there's a lot of talk around the US debt. And if you go to the usdebtclock.org, you can see that the US national debt is up at 28 trillion. Now, if you think about people, when they have debt, they need to be earning enough money on a daily, weekly, and yearly basis to service that debt. And in a low interest environment, that's normally the time when you take out more debt because your interest payments are almost zero, unless you're Evergrande and you're paying 500%. What does the debt actually do? Well, every day you can go to the Treasury site and you can pull up their actual, what they actually spend their money on. And here we had a letter actually from the Treasury Secretary Yellen. She used to be the Fed chair, but now she's part of the US Treasury. And it says here, after the debt limit was reinstated on August the 1st, the Treasury began employing certain extraordinary measures to continue to finance the government on a temporary basis. So the actual US government needs to issue debt to pay for, all of its liabilities. And that can be things like Service Retirement and Disability Fund, the Postal Service Retiree Health Benefits Fund, all of these different things, which, in the past, there has been times when the debt limit has been hit, and because it's such a political football and, neither side want to sort of say to the citizens of the US, oh, we just increased the debt again. They use it as a, political football to make the other side look bad. And what it turns out is that, by Treasury Secretaries Yellen's estimates, they're going to run out of money by October. So their extraordinary measures will be exhausted during the month of October. That's the start of the fiscal year. And the Democrats and the Republicans will be looking to make each other look bad, whilst, President Biden just wants to start, spending money, getting things like the infrastructure bill through, and then also making sure that, his sort of things that he wanted to do in his manifesto actually happen. Whether or not the park keepers get paid from October will be, all those people that, work for the federal government, they'll be looking to the actual government to pass these debt limits. And if we go to, you can see here that, where is it on? Yeah, so the statutory debt limit was temporarily suspended from August the 2nd, 2019. So whilst the previous administration were, in power, they were able to suspend the debt ceiling, which then gave the government, the ability to issue as much debt as they needed to pay for things, which, happened to be the coronavirus and, stuff like that. But as of August the 1st, 2021, the debt limit was increased back to, what it was previously. And that's when we hit the debt ceiling, which now means that the US Treasury cannot issue any more new debt. It can't additional debt. It can't, create. So if you go back through all of their actual withdrawals, it's things like supplementary nutrition assistance programs like SNAP. That's a large proponent of what they spend their money on. So this is, Social Security. This is Medicare, Medicaid. It's basically all of their federal employees' insurance payments. Here we've got another one, interest on Treasury securities. That's all stuff that needs to be paid for. So, here's like basically, the expenditure of the US government written out on a daily basis. You can see that this is the August the 2nd. And then the most recent one is September the 16th, 2021. So last week. So obviously they take money in, they get deposits, and then they, spend their money. And so what I've been doing is I've been tracking the yearly spending of the US Treasury, and call these net flows. So here we have the net flows from 2005, the yearly net flows this is, till present day. If you look to this little column here, 2005, they were basically a $2.7 trillion economy. And now you look down here, sort of 16th of September 2021, the amount of spending that's gone into the economy is 7.5 trillion. So that's 7.5 trillion of money that's been spent into the economy. And you can see here that as the blue line, the net flows basically go up. As the downturn came in 2008, 2009, they really ramped up their spending. And then the stock market was able to recover a couple of years later. And then net spending flattened off. And then as we look to sort of 2019 to 2020, that's when you start seeing this acceleration again, and also the S&P here accelerating. So this time we're looking at, or on this chart, we're looking at those sort of same flows. So that's the same blue line here. But this time I've put the S&P in gray, and then underneath it, I just want to sort of show how as the deficit rises, then that also, is an indicator of, spending into the economy. And then that's deficit rises basically when there's a downturn, you see them like pump more money in. And then that's when we get the acceleration higher. And here you see again, this period here, we've got a move higher. And that's when you sort of see the S&P rising as well. So deficits and debts and government spending has actually been very good for the economy based on the S&P 500. Obviously, that goes to corporates. It doesn't necessarily go to the wider economy like you and me. But for the stock markets, more debt would appear to be good for the likes of the S&P. So what is a deficit? A deficit is all the money that's deposited. So all the money that the federal government takes in minus spending. So that's what I've been tracking. And I just wanted to point out that even though people look to the debt ceiling and the national debt as being a bad thing, is because they're thinking of it like their own personal debt. But maybe we should start thinking of these flows, this spending, as just a transfer of wealth from the US government into the economy. And yes, a lot of it goes into the sort of stock exchange, but that then sort of dribbles down to everybody else. So a quick look through what's going on. With the rising dollar, we've got the Chinese yuan here, the CNH, that's weakening as the US dollar rises. But so far, there's nothing really out of the ordinary. We've kind of been here before. Hong Kong Stock Exchange, definitely not enjoying the sort of the risk coming out of the Evergrande at the moment. That's translated into US equity, UK equities this morning. And we've had a big pull down, and on the weekly chart, we've come down to these moving averages, which might act as support. But on a daily chart, we've actually spiked through the 200 period moving average. So there is, it's not necessarily contagion in terms of the financial risk, but in terms of risk off, risk on, the markets are definitely risk off at the moment, which is why we're seeing moves into the likes of the US dollar, more so into the yen than the dollar in the US dollar yen. They're definitely buying up the yen here. And in gold, there's obviously some sort of risk off flows into the precious metals. It's a store of wealth. It's an inflation hedge. It's many things to a lot of people. But at the moment, even with a stronger US dollar, the gold is rising today. With higher prices for dollar denominated commodities, you've actually got the oil coming off now. And I did have copper up earlier, but I've got rid of it now. But yeah, copper is also looking like it wants to come off, which will be bad news for commodity pairs like the Australian dollar and the New Zealand dollar. And if you look to the dollar CAD, with falling oil prices and rising US dollar, the US dollar versus the CAD is also rising. But remember, we've also got the Canadian elections today. So there's uncertainty around the Canadian dollar itself. And that's another reason why there's flows into the dollar CAD. But, you know, if you go to the weekly chart, we're basically just running into overhead resistance. So it's going to take a big sort of, you know, to sort of say this bullish trend is going to continue rather than not. You know, we're going to need to see a move up, a retest, and then a continuation higher. And that will happen on dollar strength rather than Canadian weakness. Okay, that's probably it for now. I hope that was informative, and any questions, please leave them in a comment below, and I'll catch you later.